Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. In the previous episode, we laid the groundwork for mean reversion. We traced its origins from basic statistics into the world of finance, specifically looking at how it revolutionized technical and price-based analysis. An important character on that topic was John Bollinger, the creator of Bollinger Bands. We explored how he utilized the mean and standard deviation to create a visual framework for price volatility. Today, we are taking the next step. We'll dive into the different types of mean reversion strategies available to traders, and by the end of the episode, we'll build a foundational strategy together that you can explore. So without further ado, let's get started. Compared to trend following, for some people, the concept of mean reversion can feel a bit counterintuitive, and for good reason. It requires a different psychological view of the market. Before we dive in, I am assuming you already watched our series on trend following. If you haven't, I highly recommend starting there. You see, the logic behind trend following is straightforward and mirrors our natural instincts. We see an asset's price rising, we assume that upward momentum will continue, and we buy. It is about joining the crowd. Mean reversion, however, operates on an inverse logic. Trend followers say price is going up, it will likely keep going up, that is price momentum. Mean reversion folks say price has moved too far, it is likely to snap back. Just the way a rubber band does. As a mean reversion trader, you are trying to participate in that snapping back part. So in a mean reversion trading setup, when you see price surging, you don't buy. You prepare to sell. You're essentially betting that the asset's price has become overextended, gone too far that is, and is due for a correction. An easy way to describe the two is to think of them as trend versus counter trend. Now keep that snapping back image in your mind because it leads us directly to our first major nuance. Mean reversion actually happens in two distinct ways. The first is the most common, simple price reversion. This is when an asset's price moves too far from its own average and eventually snaps back to it. Take Nifty for example. If you look at the Nifty spot for the past couple of months especially on an hourly time frame, you'll see it frequently exhibits this pendulum-like behavior. It might rally 2 steps up, but it almost inevitably retraces 1.5 steps back towards its baseline. Take a look at this chart. See how the price repeatedly crosses the moving average and then gets pulled back. It's as if the moving average line is some sort of a magnet. We call this single asset mean reversion. It is the study of a single price series and its relationship with its own historical average. Now moving on to the next type. Sometimes, instead of tracking price, we track volatility and expect it to revert to its mean. To understand this, let's look at one of the simplest way to measure volatility, the range. As I have explained in the key metrics video, definitely check it out if you haven't. The range is simply the difference between the high and the low on a given time frame, be it daily, weekly, or hourly. When an asset has a high range relative to its price, we call it volatile. And this thing called volatility is inherently cyclical. You will have weeks of explosive price action, that is high range, followed by periods of calm, that is low range. It doesn't stay at extremes forever, it reverts. Look at this chart. The purple line represents the daily range as a percentage of the opening price. And the red line is its 5-day simple moving average. Notice how the range spikes, moves away from the average and then inevitably collapses back towards it. This is mean reversion in action. But remember, this isn't a price chart. What you're seeing here is the behavior of volatility. Now why does it matter? Understanding volatility reversion allows us to anticipate explosions in price. For example, the Bollinger Band squeeze. When volatility reverts to an extreme low, the bands squeeze together. Traders watch this because they know a reversion towards high volatility, that is an expansion, is coming, often leading to a massive breakout. Narrow range patterns. Famous traders like Toby Crable built entire systems around narrow range. Patterns like NR7 betting that after a period of restricted range, the market is due for a big move. If you trade options, you can play volatility directly without even picking a direction. If you are anticipating expansion, that is, you expect the volatility to explode, you might use a long straddle or strangle. Or if you are anticipating contraction, that is, volatility is at a historical high and you expect it to settle, you might use a short strangle to profit from the crush. The key takeaway here is mean reversion isn't just about price levels. It applies to many statistical features of the market, including volatility and range. There are many more market features where mean reversion comes into play. There's a category of trades which belong to what I would call relative value mean reversion trades. These strategies can be applied to different versions of the same asset or across entirely different but related assets. The classic spot versus future arbitrage trading, more commonly known as basis trading, is exactly that. It exploits the temporary price gap between spot value and futures price. This again needs a dedicated episode for itself, but if you're curious, I will share a few links that explain contango and backwardation, the two market states that create these opportunities. Next, we have calendar spreads, which are possible in both futures and options. The core logic again remains the same here. There is a fair price and we have a way of measuring the fair price, and when the individual asset prices deviate from that fair price, it leads to an arbitrage opportunity. A simple example of this would be a calendar spread between two expiries of the same underlying. Now, instead of taking a directional view, we construct a position that is long one expiry and short another, effectively isolating the price difference between the two contracts. There is a fair value for the spread driven by carry and time to expiry, and when the market prices this relationship away from that fair value, it creates a mean reversion opportunity. Such a trade is exited not at expiry but when the spread converges back to its normal range. Then we have the conversion versus reversal arb trades, where trades are based on the principle of put-call parity, which states that a combination of options can synthetically replicate a futures position. When the real futures and the synthetic futures deviate in price, an arbitrage opportunity arises. If you're new to the concept of synthetic futures, I'll share a link. A word of caution. In highly liquid instruments such as Nifty futures and options, price deviations tend to correct quickly. If a deviation continues to persist, it is usually for a structural or informational reason and may not represent an arbitrage opportunity. So in totality, the point I'm trying to make with relative value mean reversion trades is that we aren't betting on the price of the asset itself. We are betting that the price relationship between two instruments or two assets will revert to its mean. So far, we've only looked at relative value within the same asset. But relative value can also exist across different assets. The iconic Morgan Stanley black box strategy, now known as pairs trading, is a prime example. Discovered by Jerry Bamberger and Nunzio Tartaglia at Morgan Stanley in 1980, which in turn led to the entire field of statistical arbitrage, or what we now call StatArb. For instance, you might select two highly correlated stocks such as HDFC Bank and ICICI Bank. You track the correlation, and when that relationship diverges, you take a long or short position on the respective stocks, anticipating that the relationship will revert or converge. I know, and I'm of course oversimplifying it, but these concepts are complex and warrant their own dedicated episode. These strategies gain popularity because they are market neutral. This means the performance is independent of the general market trend, with the bet solely on the price relationship between the two stocks or assets. Incidentally, the infamous LTCM long-term capital management also heavily utilized pairs trading strategies. In summary, when we talk about relative value mean reversion, the combination of different assets and methods of deriving a fair value can all differ, in turn giving way to multiple ways to figuring and capturing mispricing across assets. So far, we've looked at different types of mean reversion strategies that could exist. Now let's move something closer home, something more hands-on. What I would do is to design a simple mean reversion strategy on Nifty and gold and share the results with you. It's an example of price-based mean reversion on a single asset. The strategy is as simple as it can get. It's a long-only strategy, and if you ask why long-only, because who in their sane minds would want to short either Nifty or gold? So we take Nifty and gold on a daily time frame, apply the Bollinger Band using the classic 22 parameters. What that means is a 20 period SMA and a 2 standard deviation band around that SMA. The entry logic is we track the price till we get a close below the lower Bollinger Band. As you can see in the image, once the price closes below the band, we keep tracking the subsequent candle closes. And then when the candle closes inside the band, we go long with the low of the initial candle as the stop loss. We then have a trailing stop loss system to capture the trends. We trail stop loss based on the lower Bollinger Band. If the price again in future closes below the lower Bollinger Band, we exit the trade. Post-exit, we again keep waiting for the close below the lower Bollinger Band for the next trade. Before I present the strategy performance statistics, some disclaimers. 1. This is not a recommendation to trade. This strategy by itself may not even make sense to trade. The purpose of this backtest is to show you how to apply a mean reversion logic to an asset like Nifty or gold. The backtest does not factor in costs and slippages. Few more things. This is a strategy that would take very few trades, approximately 6 trades a year, and each trade may run into months. So in reality, you would have to roll over multiple times if you are trading futures or options, and that too would add to the costs. Lastly, a note on returns calculation. Returns shown here are trade-based returns, trade close specifically, not portfolio or NAV returns. For each trade, return is calculated as exit price minus entry price divided by entry price. Yearly returns are the sum of all the trade returns within that calendar year. These numbers reflect strategy edge across trades independent of capital, lot size or compounding. With the disclaimers done, let's look at the equity and the drawdown charts. I see two things here. Since both Nifty and gold are long only, and since both are slightly inversely correlated, it's evident in the chart. The blue line trending up post 2020, whereas the orange line underperforming during that same phase. You can also see this table and get a similar sense. 2021 was a standout year where the inverse relationship is quite evident. So are the years 2024 and 2025. You see 2026 returns because there are trades that are active from 2025 that are continuing into 2026. Here's a more detailed performance metrics of the strategy. As you can see, we just have 60 and 51 trades over a 10-year period. This strategy blends mean reversion for trade entry with elements of trend following to capture an upward move once the price acts favorably. If you look at the performance statistics table, you can see that the cumulative returns over a 10-year period are nearly identical for Nifty and gold. But gold does offer a better relative return to its max drawdown. Nifty, however, exhibits slightly higher win rates. If you ask me frankly, mean reversion strategies are not meant to be traded in isolation. And if you listen to Tom Bazo talk about his filling the potholes concept, the idea is simple. When you run trend following strategies, adding select mean reversion strategies can help smooth out the overall equity curve. They tend to perform well in market phases where trend followers struggle and vice versa. The backtest shown here is intentionally very basic. Think of it as a starting point. A framework you can build on by adjusting parameters, timeframes, and execution logic to see if it fits within your own portfolio. Please don't blindly copy what I've shared. Without proper customization, risk controls, and portfolio context, it is unlikely to work as intended. With that, we come to the end of this part 2 on mean reversion trading. In the coming episodes, we'll explore a few more ways to express the idea of mean reversion. Not just to price, but other market features as well. I hope you found this episode useful and interesting. Do share your questions, thoughts, and feedback in the comments, and I'll do my best to respond. Thank you for watching and see you in the next one.